Hey everyone, in this video, I'm going to bring you one artificial intelligence growth stock that's down 68% off the high that I think makes an excellent buy for 2024 and beyond. I'm going to share with you what this company is and all of the characteristics that make me appreciate this stock and recommend it as a buy. So let's jump right into it.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, the stock I'm going to recommend is Chinese tech giant Baidu. Baidu's stock price is down 68% off the high, and it's been down since economic reopening in China in 2023 didn't create the kind of economic expansion that most analysts were expecting, including myself. China underperformed my expectations in 2023, and it looks like 2024 is going to be a similarly slower growth rate environment for China. And that combined with the geopolitical tensions with the US has these Chinese tech stocks trading at depressed valuations. But I'm going to argue that those risks are overemphasized, and I think this stock makes a good investment for 2024. And one of the reasons why I feel that way for Baidu is because of its revenue growth over the last decade. But before I share with you the revenue growth, let's look at the total addressable market opportunity for artificial intelligence. According to Statista, the total addressable market for artificial intelligence is expected to grow to $1.85 trillion by the year 2030. That would be up significantly from the $207.9 billion in 2023. Artificial intelligence is popularized by large language models like ChatGPT, but there are more applications like driverless car technology, recommender systems, and more. The companies that stand to benefit from the growth in this AI surge is companies like Amazon, Nvidia, Alphabet, Microsoft, and more. Investors getting in today could realize exponential returns from investments that capitalize on the growing effectiveness of artificial intelligence. That being said, Baidu incorporates AI throughout several of its businesses, and already the company's revenue has grown nicely from a little over $6 billion in 2015 all the way up to $18.8 billion in the most recent trailing 12 months. Although you can see in the last year and a half where revenue growth has been constrained as a result of the slower economic recovery in China. This is what has many investors concerned about Baidu stock. However, that being said, Baidu's operating profit margin is still strong and it's recovering off the lows. In late 2019, when the COVID-19 pandemic really was started initially in China and its business started to feel the pains of that, its operating profit margin was at its lowest. From that bottom, its operating profit margin has climbed nicely up to 15.85% in the trailing 12 months, and I would not be surprised if this margin moves higher over the next year and 2 years at the very least. In fact, that is what Wall Street is expecting from Baidu. And let's get a closer look at Wall Street estimates for Baidu for the next 2 years. Analysts on Wall Street expect Baidu to grow revenue by 8.5% in 2024 and 8.2% in 2025. Solid growth, not incredible growth for the Chinese tech giant. That's expected to increase earnings per share by 1.7% in 2024 and a more respectable 8.3% in 2025. Remember, this is a consensus estimate from analysts that follow Baidu stock, and this is the average among all of those analysts. Some analysts believe it can grow faster, and some analysts believe it will grow slower. This is the average among all of the analysts that are following Baidu. Over the last decade and 5 years, Baidu has done a good job increasing its cash flow from operations. You can see that number rising from around 4 billion in the trailing 12 months in 2022, all the way up to 4.8 billion in the most recent trailing 12 months. And you can see the recent year has been a good one for Baidu's cash flow from operations. And finally, Baidu stock is selling at a cheap valuation. Let's look at the forward price to earnings ratio. The price to earnings ratio is an important financial metric I use to determine which stock is more expensive or if a stock is too expensive. Let me show you this example here. I have two stocks, one trading at a market price of $100 and one trading at a market price of $12. The one trading at a market price of $100 has an earnings per share of $2.58, while the other has an earnings per share of just 11 cents. When we look at their price to earnings ratio, the one trading at a market price of 100 is trading at a price to earnings of 38.76, while the one trading at a market price of $12 is trading at a price to earnings of 114. So in this example, the one trading at a market price of 12 is actually more expensive because I'm paying 114 times earnings to purchase this stock. That means if the company was to pay me earnings per share every year as a dividend, it would take 114 years for me to receive my money back. Whereas the other stock, it would pay me back in 38.76 years. Now, there's a lot more to think about in this equation, but to simplify, that's an example that shows you why a company with a market price higher can actually be cheaper than a company with a market price that's lower. So now that we understand how to use the forward price to earnings ratio, we can see Baidu stock trading at a forward PE of 9.139. That's arguably the cheapest you've been able to buy this stock going back all the way to early 2021. You can see the forward PE valuation throughout that entire time at 9.139. Maybe there was a brief moment here in late 2022 when you were able to buy it at a cheaper valuation. But besides that point, you haven't been able to get this stock at the current value. And given that analysts expect it to grow revenue by 8.5% and 8.2%, and earnings per share 1.7 and 8.3%, I think this is a relatively good value for long-term investors. That being said, I understand the geopolitical concerns and the risks surrounding Chinese stocks and Chinese companies. I feel that's already incorporated into this valuation. Excuse me. If those risks weren't present, this stock would be selling at a more expensive valuation. So I'm not downplaying those risks. I think they are meaningful. However, I feel that they are more than incorporated into the valuation already. So the value that investors are getting, the risk versus reward potential, is favorable for investors in Baidu stock. If you liked the video you just saw and you want to see more just like it, please subscribe to the channel. I can't keep this channel free without the support of viewers like you. And if you're already subscribed, thank you, and I appreciate your support.